The evolution of Pakistan's IMF loan packages, a persistent struggle. The history of Pakistan's financial aid from international institutions dates back to 1958. As a member of both the International Monetary Fund (IMF) and the International Bank for Reconstruction and Development (IBRD), Pakistan has consistently sought financial support to stabilize its economy. Despite these efforts, economic difficulties persist, and the IMF has increasingly imposed stricter conditions. Pakistan's journey with IMF loan packages began with its first standby arrangement SPA in 1958. Fast forward to June 30, 2023, and Pakistan signed its most recent SPA, valued at approximately $3 billion. This arrangement was crucial to prevent a sovereign debt default, but it came with tough conditions that had significant political repercussions for the ruling coalition. The need for financial support did not end with the SPA. Fresh negotiations led to a new staff-level agreement in July, securing an additional $7 billion, tied to yet another set of stringent conditions. This extended fund facility EFF marks the 24th financial assistance package, but awaits approval by the IMF's executive board. The negotiation process has created a chicken and egg scenario. The IMF requires Pakistan to secure external financing, such as loan rollovers from friendly countries, before approving the EFF. Conversely, these countries are reluctant to provide support until the IMF loan is secured. Meanwhile, Pakistan is negotiating with international commercial banks for higher interest loans to meet IMF conditions. The implementation of IMF recommended reforms has led to severe consequences for Pakistan's economy. The heavy taxation measures have adversely impacted the industrial sector, reducing production and exports. The focus on revenue generation through high taxation, rather than promoting GDP growth, has been criticized as a flawed strategy. The IMF's influence extends to various sectors, from fuel price adjustments to power tariffs, which have stifled economic growth. Additionally, the floating exchange rate mechanism and high interest rates have further exacerbated the country's economic challenges. The IMF's directives have also affected the agricultural sector by discouraging support price mechanisms. The IMF's policies are worsening poverty among the poorest segments of society. The scrutiny of subsidies and relief measures has further highlighted the disconnect between IMF policies and the needs of the population. Pakistan's relationship with the IMF is fraught with complexity. Despite repeated assurances that a loan would be the last, the country finds itself seeking further assistance to avoid a default. The IMF's stringent conditions, while necessary for temporary relief, are often seen as exacerbating the country's economic woes rather than providing a long-term solution. For more insights and updates, keep watching the Qasim Khoso YouTube channel.